Today I am going to solve three important questions. So if you have any question, okay, you can stop me anytime, but try to understand the lecture clearly because this is important. So first we are going to talk about how to calculate the present value if it is a face amount bond and how to record the journal entries. So read the question carefully. They assume that on January 1st, 2005, this company issued the following bonds. So face amount is $100,000, it is given, and the contractual interest rate is given 12%. So why we use contractual interest rate? It is used to calculate interest expense. So we used contractual interest rate to calculate the interest expense. Then interest is paid semi-annually, another important keyword here. So interest is paid semi-annually means 2 times interest is paid semi-annually means interest is paid twice a year. So as it is a twice a year, we have to divide it by 2 and it becomes 6%. 6%. So interest is paid 2 times a year. This is the important term. And the term of the bond is 5 years, so times 2 equal 10 years. These are 10 years. And we used market interest rate. We used market interest rate to calculate the present value. To calculate the present value. And as it is semi-annually, again, interest rate divided by 2 equals 6%. So whenever you will find this question, you have to do this kind of workings by yourself. Okay, so interest, we have 2 interest rate. One is contractual interest rate, and another is the market rate. Contractual interest rate and the market rate. So we use contractual interest rate to calculate the interest expense. We use market rate to calculate the present value. And another important keywords here. Another important keywords is interest is paid semi-annually. Semi-annually means 2 times a year. One is June 30. One is June 30, another is December 31st. So 2 times a year. So we are going to convert. Compounding interest rate. So divide by 2, 6%. And the market interest rate divided by 2, 6%, and we make it our compounded times period. Now our compounded time period is 10 years. Now you can see that contractual interest rate 12% and the market interest rate also 12%. Also 12%. So these rates are similar. As these rates are similar, it is called the face amount bond. So the question will not tell you. Question will not tell you whether it is a face amount bond, whether it is a discount bond, or whether it is a premium bond. Question will not mention you, but by reading the question and understanding the question carefully, you have to figure out whether this is a premium bond, discount bond, or face amount bond. And this kind of short calculation you have to do from the very beginning. Now question said that calculate the present value of the bond. Okay, calculate the present value of the bond. So here we have a formula. So it is present value of face amount plus the present value of interest expense. So if we add these two together, present value of face amount and the present value of interest expense, if we add together, we get the present value of the bond. Okay, so we get the present value of the bond. And if you remember previous class, so present value of face amount, here face amount is $100,000. Okay, present value of $100,000, so times factor, and here we calculate the interest expense. So $100,000, 6%. 6% is the compounded interest rate, right? So $6,000. So we are going to record present value of $6,000 times factor. So we need factor. Now, based on our chapter 1, we know how to find out this factor. So here, to calculate the factor, we need interest rate, and this interest rate should be the market interest rate. So 6%, it is the market rate. Then we need 10 years. Okay, and we need table. We need table 2. So these are the factors. These are the factors we should understand how to get the number. So to calculate the factor, we need market rate. Okay, we need market rate. We need the time period. And why we are going to use table 2? Because this face amount is only one time, right? Future cash flow is only one time. $100,000 future cash flow is only one time. So we use table 2. But whenever we calculate the present value of interest, here interest is not one time. Interest is 10 installment, right? 10 installment. So we're going to use table 4 here. So this is the formula. To calculate the present value. We record present value of face amount. So we need a factor. And if you don't know how to find the factor, that means you are going to do mistake. Okay, to calculate factor, we need market interest rate. We need compounded time period. And we need to know which table is suitable. Okay, so table 2 is suitable. Why? Because future cash flow $100,000 is only one time. And present value of $6,000. And we calculate this $6,000. Look at here. We calculate this $6,000 based on contractual rate, right? Based on contractual rate, we calculate this $6,000. And this is the factor. Then after that, we have to record journal entries. So here, question said that record necessary journal entries. Okay. So what are the necessary journal entries here? We can see. So first, we have to record issue of bond. We record issue of bond. Okay. Here, when we record issue of bond, we compare present value versus face amount. So we are going to compare face amount and present value to record the issue of bond. Okay. Then record interest expense. record interest expense. So when we record interest expense, we have to record it twice in 1 year. Okay. Okay. 1 year, year one, for example, year one, we have to record interest 2 times. One is June 30, another is December 31st. And we have to follow the same for each year. Okay, so this journal entry, year one journal entry, okay, year one journal entry is the same for each year. Then third journal entry is about record bond at maturity date. So at the maturity date, we are going to return back the bond money. So here we are going to use only face amount. Face amount. So when you record the bond, okay, when you record the bond, I repeat again. When we record the issue of the bond, okay, we compare our present value and we compare our face amount. But when we record the maturity of the bond, then we use the face amount. Okay, we pay the face amount. Now, based on this question, I draw this diagram. The first question is here. First question is here, calculate the present value of the bond. Calculate the present value of the bond. So if I draw the diagram, my question is here. What is the present value of this bond today? Right? What is the present value of this bond today? And this is the diagram. According to this question, at the end of year 5, at the end of the year 5, we are going to pay the face amount, right? At the end of year 5, we are going to face amount $100,000, and we promise to pay interest 6% every year 2 times, right? Every year 2 times. This is our promise. This is our promise. So we are going to pay $6,000 June 30, $6,000 December 31st. Same for every year. This is our promise. And at the maturity date, we will pay the face amount. So what is the present value of $100,000 today? And what is the present value of $6,000 today? I already explained here. I already explained how to calculate the present value of face amount, how to calculate the present value of interest expense. If we add these two together, this is called the issue of the bond. Okay, issue of the bond means present value of face amount and present value of interest expense together is the face amount, right? Together is the issue of the bond. Now, based on this diagram, this is our table. Okay, this is our table. We calculate the present value of the face amount. Present value of face amount is this. Is the present value, and this is the present value of interest. Present value of face amount, present value of interest. Now, if we add these two, we find the total present value. We find the total present value. Do you understand? Now, this is the present value. Again, this is the present value. This is the present value, and this is the face amount. This is the present value and face amount. So first journal entry, can you remember? When we record the issue of the bond, we compare we compare our present value and the face amount, right? When you record the issue of the bond, we compare present value and the face amount. So according to this question, we see that face amount is $100,000 and present value also $100,000, equal, right? As this is the equal, this is called face amount bond. Why equal? Why these two number equal? Because company interest rate and the market interest rate similar, right? As two amount of rate similar, so their present value and face amount also similar. Now, based on this table, look at the new diagram. Look at the new diagram. So this is the new diagram. So before it was the question mark here, right? We had question mark here. What is the present value? Now we calculate this. We calculate this and we find that present value is $100,000. Now we are going to record journal entry here, right? This is the first journal entry. Then this part is the second journal entry. And this part is the third last journal entry. So look at the first journal entry, record the issue of the bond. So first, I told you that we have to compare. We have to compare present value. We have to compare present value and we have to compare the face amount. We compare present value and we compare the face amount. So today you receive cash, right? Today you receive cash. So your cash increase, right? Your cash increase. So today you receive present value, right? Today you receive present value and it is related with cash increase, but 5 years later you are liable. You're liable to pay the face amount. You're liable to face amount. So according to this diagram, we find that this two number is the similar. This two number is the similar. But in another situation, these two numbers may not be similar. But this situation, it is a face amount bond, so these two numbers are similar. Present value similar, you receive cash increase debit, and we are liable to pay this money, right? This is our liability actually. This is the liability. This is our liability. We are liable to pay this money 5 years later. So we record liability today. We record our asset today. Today we receive cash, but we are not happy. Why today we are not happy although we receive cash? Because this is the money we are liable to pay, right? So this is other people money you receive today. This is not your earnings, okay? This is not your earnings. This is other people money. You sell a piece of bond, you sell a piece of paper, and you receive 100,000 US dollar. It is good that you receive some cash today. You can use this money to do your business, right? If you have cash, you can do your business, right? But don't be happy too much because you are liable to pay this money. So as you are liable to pay this money, you have to record liability. Now, after recording issue of the bond, then we are going to record our interest expense. According to this question, our interest expense is $6,000. First interest expense $6,000 in year 1, June 30, and second interest expense year 1, December 31st. So I told you that for every year, year one, we are going to record interest expense, one for June 30, another for December 31st, and it should be same for every year. So I am going to show you only year 1. I am going to show you journal entry for only year 1. And if you understand year 1, year 2, year 3, year 4, year 5, same journal entry. So this is interest expense, and according to your principles of accounting 1 knowledge, you know that expense increase debit, right? Expense increase debit. So here you can see that this is our interest expense. So interest expense debit, and in June 30 we pay cash, so cash credit. interest expense debit, and the cash credit. Right? So June 30 and December 31st also, because in December 31st, we are also going to pay $6,000. So this amount are the similar. So this part is the journal entry for interest expense. Interest expense debit, cash credit for June 30, interest expense debit, cash credit June 30. Based on this part, you can see that 6,000, 6,000. Do you have any question up to here? Issue of the bond, journal entry, and the interest expense, any question? No, right? Now come here, the maturity date. What happened in the maturity date? We are going to pay this money, right? We are going to pay this money. We are going to pay this face amount. We are going to pay this face amount. So the maturity date came, then we record bonds payable debit, and it is the face amount. Because before we record bonds payable credit as a face amount, right? So liability increase credit. Here you can see the liability increase credit. Now at the maturity date, if you pay money, your liability will decrease. So your liability is going to close. Liability debit means liability closed. We closed our liability. We closed our liability. So bonds payable is our liability. We record it as a face amount, right? We record it as a face amount on debit. So before we record credit, now we record debit. So this is closed. This is closed. Why we record closed our liability? Because we pay cash. We pay cash, so our cash decrease. Now you don't have any liability, right? You don't have any liability, and within this 5 year, you use other people money to run your business. You understand? This is other people money. You run your business by using this money, but you have to record liability from the very beginning, and when you pay money, you are going to close your liability. So do you have any question about the face amount bond? Any question? Now, if you don't have any question, let's discuss another question here. Bond issued at a discount. So again, read this question. Assume that January 1st, 2005, this company issued the following bond. The face amount is given, contractual interest rate given, interest paid semi-annually, term of the bond 5 years, and market interest rate is 14%. Now, as this is the important keyword, that interest is paid semi-annually. Okay, we have to calculate the compounded interest rate, and we have to calculate the compounded time period, right? So how to do that? Because it is, I repeat again, 2 times a year. %6, right? 6%. 6% means $6,000. So we calculate this, and we find that interest expense is $6,000. Now we convert the compounded time period. We make the compounded time period, right? And we also calculate compounded interest rate for market. market. So this is the market interest rate. This is the market interest rate 14%, and this is the company's interest rate 12%. So this is a good news or bad news? You want to give them 12% interest, but market said that I need 14% interest. So it is a good news or bad news for the company? Bad news, because you have to pay more interest expense. First you decided to give them 6,000 interest for every installment, right? But actually market said that no, we need more. So we are going to pay more interest expense. Now, first question is here again. First question is here, how to calculate the present value of bond today. How to calculate the present value of bond today. So this is your first question. This is your first question. That means if I show you the diagram, this is the question mark. So you're liable to pay $100,000 5 years later. Every year you are going to pay $6,000 interest. Okay, company interest rate is 12%, market interest rate is 4%, 14%. What is the present value? What is the present value? So here, according to this question, market interest rate is 7%, right? Market interest rate is 7%. So we just change here 7%. We change here 7%. This is only one change. This is only one change. So present value of $100,000 times factor. And to calculate factor, which rate we need? Don't forget this. This is very, very important. To calculate the factor, we need market. Okay, to calculate the factor, we need market interest rate. We need market interest rate. This is the important for every question. And compounded time period is 10 years, no problem. And you should know which table is suitable for face amount and which table is suitable for interest. Okay, so we do this here. And again, when we record this journal entry, that means when we record the issue of the bond, you remember we compare present value versus face amount. Right? When we record the journal entry, we compare present value and the face amount. So here, the present value is this amount. This is the present value, right? This is the present value. 92,976 is the present value, but what is the face amount? What is the face amount? So I can write here. Is the present value, but the face amount is this. So look at the diagram. Present value means this money you receive today, right? This money you receive today. So look at the diagram here. So today you receive $92,976, right? But 5 years later, you are going to pay the face amount, right? 5 years later, you are going to face amount. That means you are going to pay 92,976 plus you are going to pay more money. You receive less money today, right? You receive less money today, but you are going to pay $7024 more. Clear, right? Yes. So face amount and the present value is not similar. So according to this question, we analyze this, we find that face amount and present value is not similar. Okay, so look at the journal entry for the first one. Look at the journal entry here first. So first I'm going to explain this part. That means what happened today. Today you issue bond, right? Today you issue bond and you receive cash. And I told you that we are going to compare present value versus face amount. So bonds payable is the face amount, you know that. We always record bonds payable based on the face amount. Okay. And this is the definition of the bond. So we should record the bond payable based on the face amount. So this is face amount. This is the face amount. This is the face amount of the bond. And we receive cash from market today, right? Cash means this is the market value you receive today. Market value means the present value. So you receive $92,976 today, but your liability is to pay $100,000. You receive cash $92,976, but you are liable to pay $100,000. So this is a bad news, right? This is a bad news. So you can see that debit and credit is not equal. But in Principles Accounting 1, we learned that we have to follow double entry system. And according to double entry system, debit and credit must be equal, right? Debit and credit must be equal. So here, debit and credit is not equal. So in order to record debit and credit equal, we have to put some additional money, right? So additional money, should we put debit side or credit side? Where we will put additional money to make it equal? Which side? Debit side, right? So if we put some money here in the debit side, then debit and credit equal. And the difference here is, this is the difference. This is the difference. If we put in the debit side, now debit and credit equal, you can see. Now debit and credit equal. Now what is the name of this account? The name of this account is called discount on bonds payable. Okay, so we record discount on bonds payable. Okay, we record discount on bonds payable in the debit side, because face amount and present value is not similar. Okay, so the difference is called the discount. Now, what is this money actually? What is this money actually? Let's see the diagram. Let's see the diagram. So according to this diagram, we find that today you receive $92,976. 5 years later, we are going to pay $92,976 plus some additional money, right? So this additional money plus sign means it is our bad news, right? It is our bad news because we receive less money, but we are going to pay more money, right? So bad news. This is absolutely a bad news. And bad news means this is called the additional interest expense. So you are liable to pay, look at here, you are liable to pay $6,000 interest expense, right? $6,000 interest expense every installment. This is your promised. You promised them, right? You promised them that if you buy my bond, I am going to give you this interest. But finally, you find that in addition, you are going to pay more money actually, right? In addition, you are going to pay $7,024 more. And this $7024 more is the bad news because it is the plus sign. Plus sign means we have to pay more money, and this more money is called additional interest expense. Right? Additional interest expense plus sign. So additional interest expense sometimes plus sign, sometimes minus sign. So in our example, in this example, this additional interest expense is the plus sign. That means that we have to pay this money more. Okay. So as it is a bad news, it will increase our expense, right? It will increase our expense. So we have to record it as a debit, something like this. Now try to remember your principles of accounting 1, matching principle. Can you remember your matching principle? What is the meaning of matching principle? Matching principle said that you have to match your revenue and expense every year, right? That means whenever you have revenue, whenever you have expense, you have to record it for a specific year. So this is year 1, you can see that. This is year 1, we have 2 interest expense. We record June 30, we record December 31st. So this interest expense for year 1, this interest expense for year 2. So we have to record it every year, right? Now this $7024, this $7024 is also our interest expense. This $7024 is also our interest expense for how many years? It is for only 1 year or it is for 5 years? This $7024 is only for 1 year or it is for 5 years? You have to understand. 5 years, right? So if it is for 5 years, you understand. It is for 5 years. But if you record it only one time, if you record it only 1 year, it is your mistake. Do you understand? If you record $7024 only one time in year 1, it is our mistake because it is for 5 years. So here you can see that we record year 1, this is year 1, right? Year 1, we record discount on bonds payable $7024. If we keep up to here, it is our mistake. Okay. Why it is our mistake? Because this additional interest, so this is actually called additional interest. Additional interest. This is our additional interest expense. So if we record it only one time, it is our mistake because we have to follow the matching principle, right? Matching principle means every year expense we have to record in every year. Now what we are doing, look at here. As this is our interest, additional interest expense, right? We are going to allocate this money for 5 years. Do you understand? So why we divide by 10? Why we divide by 10 here? Divide by 10 here means every year 2 installments. So in 5 years, it is 10 times, right? It is 10 times. Do you understand? It is 5 years, every year 2 times. So 10 times installments. So $7024. It is mistake here. You should correct it. $7024 divided by 10 installments. Okay, 10 installment. So every installment is $702. So we transfer this money. We transfer this money, $7024 for every year. Plus sign. Plus sign. Why plus sign? Because this is additional money we have to pay. So we transfer this money every year. We transfer this every year. If we transfer this money every year, it means that we follow the matching principle. Now tell me, if you transfer $7024, it is important part. If you transfer, this is the discount, right? $7024 is the discount, right? We transfer this money to every year interest expense. If you do that, which account is increasing and which account is decreasing? So first we record 7024 debit, right? Look at here. First we record 7024 debit. Do you understand this? After that we have to follow the matching principle. After that we have to follow the matching principle means we have to transfer this expense for every year. Now tell me, when you transfer discount to interest expense, which account is increasing and which account is decreasing actually? Because if you transfer something from one place to another place, right? One account will increase, another account will decrease. Very simple, right? You have some money and you give it to me money. So if you give it money to me, your account is decreasing and my account is increasing, right? So we record discount on bonds payable debit, right? Now we transfer this money. We transfer this money to the interest expense. So interest expense will increase and discount on bonds payable will decrease. Clear? Yes. So we can say that we record discount on bonds payable only one time. It is our mistake because here we did not follow matching principle. Now we are going to transfer this money. Look at here. We are going to transfer money here. This is year one, okay? Because year one and year two, year 3, 4, 5 all are same. So we transfer money from here, right? Look at here. This is our money, discount. This is our discount for how many years? For 5 years, right? Now we transfer this money year one, June 30, year one, December 31st, right? Again, year two, June 30, December 31st. Year 3, June 30, December 31st. So we are transferring. We are transferring money. We are transferring this money from here to here. So this is increasing and this is decreasing. Now look at here. Discount on bonds payable, increase debit, right? And when we decrease it, discount on bonds payable credit. Before we record in discount on bonds payable debit, right? Before we record discount on bonds payable debit, now we transfer this money from discount to interest, right? To interest. So interest expense will increase. Look at here. Interest expense is increasing. Interest expense is increasing and discount is decreasing. Discount is decreasing. Clear? Okay, so we do the same. Now we can see that our actual interest expense is before. Our actual interest expense was $6,000. Now we are going to add some more interest expense, right? Because we have to pay more money. We have to pay more money. So we record interest expense debit because it is increasing. Look, plus sign means it is increasing. $6,000 plus interest, additional interest component. So debit is $6,702. Okay. Then we credit discount. We credit discount means it is decreasing and it is transferring to interest expense. And we pay cash. Now, someone tell me, we record interest expense. We record interest expense more $702 today, right? We record interest expense $702 today. Why? For matching principle, right? For matching principle, we record $702 today, and it become $6,702. But when we pay cash, we are going to pay only $6,000. What is the problem here? We record expense $6,702, right? We record expense $6,702, but we are going to pay cash $6,000 today. When you will pay the remaining money? When you will pay the remaining money? So you record expense $6,702, right? But you pay cash today $6,000. That means you pay less cash. You pay less cash. When you will pay another amount? When? Maturity date. Very good. Look at it. At the maturity date. At the maturity date, we are paying cash, right? We are paying cash $92,976 plus $7,024, right? So we record. Look at here. We record today. We record today additional interest expense, but we pay cash at the maturity date. Clear? Yes. So that's why our interest expense is higher today. Why higher? Because we follow the matching principle, right? We follow the matching principle, but we are not liable to pay money today. We record expense today, but we are going to pay some cash today and some cash we will pay later on. So today we pay some cash and some money we will pay the maturity date. Very good. So this is the interest expense for June 30. This is the interest expense for June 30. And this is this interest expense, the same journal entry for December 31st. So this is year one. This is what interest expense. This is year one. This is year one interest expense. So for year two, Year 3, year 4, year 5, same journal entry. Same journal entry like here. Same journal entry like here. Our discount is going to decrease, right? Discount is going to decrease. It is going to add with interest expense every year. So discount is decreasing. Discount is decreasing. Okay. Now, when the maturity date came, you know that maturity date came, bonds payable is always face amount. Bonds payable is always face amount. We always follow the face amount for the maturity for the bond. So bonds payable, liability increase date credit, liability increase credit. Now our liability is going to decrease. Liability increase credit. Now our liability is going to decrease. Why our liability is going to decrease? What is the reason our liability is going to decrease? Yeah, we are going to pay, right? We are going to pay. So our liability account closed. Decrease means liability closed. Liability closed. We closed our liability. Why we closed our liability? Because today is the maturity date, right? Today is the maturity date. We are going to pay cash. And here we can divide this money, present value plus, right? We are going to pay the present value plus we are going to pay additional. Look at here. We pay less money, right? We are supposed to pay 6,702, but we pay 6,000. The money we are going to pay at the maturity date. So here we are going to pay this money. We are going to pay this money plus 7024. 7024. So we pay our, how to receive, we pay it, and we pay some additional interest expense, right? Cash. This additional interest expense we pay at the maturity date. Now it is closed. Now it is closed. Do you have any question from this journal entry? Do you have any question? Okay, so let's discuss another question, then you will understand more. Let's discuss the premium bond. Again, the question may not tell you is a premium bond or discount bond, you have to understand. So face amount $100,000, no problem. Contractual interest rate 12%. Interest is paid semi-annually. So this is very, very important for this question. For every question of this chapter, you have to find out this one first. Interest is paid semi-annually, annually, quarterly, or monthly, something like this. And you should know what is the meaning of semi-annually, 2 times. 2 times. So as it is 2 times, we have to make compounded interest rate, right? We have to convert compounded time period. We have to convert compounded market interest rate. How to do that? I repeat again and again so that you can remember. Now 6%. Now as it is 6%, what is the interest expense now based on this 2? If we calculate interest expense, now it is $6,000. $6,000. So $100,000 times 6% is the $6,000, right? Then compounded time period, now 10 years. Compounded time period now 10 years. So we find the compounded time period. Now we have to convert the compounded market interest rate. As it is semi-annually divided by 2 equal 5.5%. 5.5%. So we find this information. Now we should know, we already show you that contract rate is used for calculation of interest. So we use contractual rate. We use contractual rate to calculate the interest expense. Look, we calculate the interest expense, right? And when we use the market rate, we use market rate calculation of present value. Calculation of present value. So this is important point, right? So you already read your question carefully. Now your first job is to calculate the present value of the bond today. Then let me copy something from here. So present value of face amount, present value of interest expense. So present value of 100,000 times factor, present value of $6,000 times factor. So $100,000, how to get the factor? It is now 5.5. Market interest rate is 5.5%, right? And we also change here 5.5. So we find that market interest rate is 5.5%. For interest expense, we are going to use table 4. Okay. And table 2 for present value of face amount. Now, if you do this kind of calculation, the answer is this. So this is the present value we calculated. The present value. Now, when we record the journal entry, we compare present value versus face amount. We compare present value versus face amount. So here, present value and the face amount not similar, right? Present value and face amount not similar. What is the present value? This is the present value. And what is the face amount? Face amount is $100,000. So we compare present value and the face amount. Now, based on this information, let me show you the diagram. Okay, let me show you the diagram. So what is the meaning? Meaning is present value means you receive cash, right? Present value means this is the money you receive cash today, right? This money you receive today, but you are liable to pay $100,000. So it is a good news or bad news? Good news, because you receive more money, but you have to pay less money. So look at this diagram first. So you are liable to pay $100,000, and plus you are liable to pay, right? You are liable to pay interest expense, right? But when we convert it into a present value, we find that actually we receive higher money, right? Actually we receive higher money. So $103,769. So this is a good news. Why it is a good news? Because we no need to pay some money, right? What is the amount of money? Look at here. You receive $103,769, but at the maturity date, you are going to pay $103,769 minus $3,769, minus sign. Before it was plus sign. Can you remember? Plus sign means you pay more money, right? And minus sign means you are going to pay less money. And it is additional interest you no need to pay. Try to understand. This is called it is additional interest and you no need to pay this interest. Clear? So this money you no need to pay. Try to understand. 3769, you no need to pay, right? You no need to pay means that your interest expense is going to decrease. Look at here, your interest expense is 6,000, 6,000, 6,000 for every installment, but we are going to deduct something from our interest expense. So this money we no need to pay. It is the good news. It is our gain, one kind of gain, okay? And we are going to offset gain with our expense. Anyway, so again, this 3769 for how many years? For 5 years, right? For 5 years. So if we record for 5 years, it is our mistake. Why mistake? Because we have to follow the matching principle. According to the matching principle, we have to adjust this interest, okay? We have to adjust this interest to every year. To every year. So that's why at the maturity date, you actually paid $100,000, right? You actually paid $100,000. So it means that 3769, you no need to pay. Now, look at the journal entries. Look at the journal entries first. So, for example, this is not given. So we are going to compare. We are going to compare present value. And we are going to compare the face amount. We are going to compare these two. So from market we receive cash. We receive cash $103,769. But our liability is lower. We receive more cash, our liability is lower. So debit and credit is not equal. Debit and credit is not equal, so we have to make it equal, right? So where should we put the additional money? Debit side or credit side? Credit side, very good. So the additional amount is this. Additional amount is this. So if we put this amount in the credit side, now debit and credit equal. So what is the name of this account? The name of this account is called Premium on Bonds Payable. So this premium is one kind of gain, right? This premium, you know that loss is debit. Can you remember your principles of accounting one formula, debit credit formula? Loss debit, right? But gain credit, right? Gain credit. So previously we record discount in the debit side. Why we record discount in the debit side? Because it was a loss, right? Now it is our gain. Why gain? Because we no need to pay this money. We no need to pay this money. It is our gain. So we record gain in the credit side. Clear? Gain is now credit. Now can you remember here? This is minus, right? Gain is the minus. So this gain is going to transfer where? This gain is going to transfer to the interest expense, right? Gain is going to transfer to the interest expense. So which one is increasing and which one is decreasing here? So this account, premium transfer to interest expense. So premium will decrease, right? And it is transferred to the interest expense. Clear? So this is the money for premium. We transfer where? We transfer to the interest expense. So premium is going to decrease here. So before we record, look at here, before we record premium credit, now we record premium debit. Now we record premium debit. Because this account going to be zero, right? This account is going to be zero. Why? Because this is for 5 years. Now we have to record it for every year. So we should not have any premium account. So premium is, before it was credit, look at that, before it was credit, now before it is debit. Okay, so this is year one. This is year one. What we are going to do. So before we record premium, look at here, before we record premium credit, now we record premium debit. Why? Because this account is going to decrease, right? This account is going to decrease. Now, our good news is that our interest expense is $6,000. Okay, and this money we no need to pay, right? We no need to pay. So look at the interest expense. Interest expense $6,000 minus 376.90. So in the exam, you can make it full dollar amount like 377. Okay, or if you can keep 2 decimal point, no problem. So you can make it round figure, or you can make it 2 decimal, no problem. Okay, I will not deduct any grade. You can follow either one. So now our interest expense is lower. You can see that. Before we assume that our interest expense is $6,000, but when we sell our bond, we sell it with a premium, right? We sell it with a premium, and we figure out that actually we are going to record less interest expense. Do you understand? Before you assume that your interest expense is 6,000, but after selling bond, you find that it is not actually 6,000. You are going to pay less money, right? So we deduct this. So look at here, your interest expense is $6,563, but how much cash you are going to pay? 6,000. Why these two amount is different? You record lower, look at here, you record lower interest expense. Look, you record lower interest expense, right? But you pay cash higher, but it should be similar, right? It should be similar. But how we can adjust, where we can adjust this money? Try to understand. We record interest expense lower, right? We record interest expense lower, but we pay cash. We pay cash $6,000. In one sense, it is mistake, right? Where we are going to adjust this? How to make it equal? Which part is related this cash? It is issue of the bond or maturity of the bond? Where? Can you remember? Can you guess from this diagram where this additional money we receive? Where this additional money belongs to? I repeat again, I record interest expense lower, but I pay more cash, right? I should not pay more cash. So how to make it? How to make it 5623.10, 5623.10, these two together, how to make it? This money already included here. Clear? This money already included here. That means you receive cash, right? You receive cash. That means you receive some face amount. So here you can see that here you receive $100,000 plus, right? You receive face amount plus you receive additional. You receive some additional interest, right? Additional money, or I can say there is some additional, okay, additional amount. So additional amount is 6,700, this money. So additional interest component is this. So you receive $100,000 plus you receive more money, right? So as you already receive more money, now look at here, you record $6,000 credit, okay, but your expense is debit, okay. So this $6,000 additional money is included here. Additional money is included here, right? Additional money is included here. So ultimately, debit and credit equal. Debit and credit equal. Now maturity date came, and at the maturity date, you pay the face amount. You pay the face amount, so your liability closed. Your liability closed. Your liability closed. And your liability face amount is $100,000 and you pay cash $100,000, so your liability closed. Okay. So you have to practice this kind of question again and again. Now I can show you how can I change the question in the exam. For example, I want to change this question. Okay, for example, I decided to give you this question in the exam, and how can I change it? For example, this is your assignment. You can do it at home. This is your assignment. So face amount $100,000, I keep it. Contractual interest rate, I keep it 12%. Okay. Then interest is paid. I can change here. Interest is paid annually. When interest is paid annually, I mentioned here it is December 31st. Okay. I said here interest is payable annually, right? Then term of the bonds 5 years. And market interest rate is 11%. Okay, so this is the first part of the question. This is the first part of the question. Assume that on January 1st, 2015, this company issued following bonds. Face amount $100,000. Okay. Then contractual interest rate 12%. Interest is paid annually. Before it was semi-annually, right? I write here annually. Annually means how many times? You know that. One time, right? Then term of the bond 5 years. Then market interest rate is 11%. Then I can ask you a question, determine the price of the bond. Okay, determine the price of the bond. Prepare the journal entry to record prepare the journal entry to record interest on December 31st. Okay, year 1. December 31st, I ask you to record only for year 1. Okay, only for year 1. For example, 2015, for example. This question is 2015. So although it is a 5 years bond, look at here. Although it is a 5 years bond, I ask you to record journal entry for interest expense for which year? For December 31st, year 1, right? And I can ask you to record the payment of the bond at maturity date. This may be one question. Okay, I can change another question here. The same question I can change. Look, how can I change it? This is assignment 2, for example. This is assignment 1. Face amount $100,000. Contractual interest rate 12%. Interest is paid quarterly. Interest is paid quarterly. So what is the meaning of quarterly? 4 times, right? When? March 31st, right? June 30. September 30, right? Then December 31st, something like this. So quarterly. Term of the bond 5 years. Interest rate is 11%. So I can ask you to prepare journal entry on December 31st. Okay. I can ask you something like this. Only first quarter. Or I can ask you only first and second quarter. So what is the interest expense in the first quarter, year 1? Okay. What is the interest expense of second quarter? So same journal entry, right? Same journal entry. Quarter 1, quarter 2, quarter 3, 4, 5, not 5, 4. Same journal entry, right? So I can ask you only 2. And what is the journal entry at the maturity? So this kind of question you can face. I can give you annually, I can give you semi-annually, I can give you quarterly, monthly. Okay. I can give you something like discount bond, I can give you premium bond, I can give you face amount bond. Anything I can give it to you. But you have to understand. You have to understand how to solve this. Do you have any question? No question? So if you don't have any question, that's all for today.